Every Monday to Friday, this is Peter Lewis's Money Talk. Money Talk.
Good morning, this is Peter Lewis. A warm welcome to Money Talk for Tuesday the 19th of March. In just a moment, I'll have an update for you on the business and finance news for today from around Asia. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's headlines, Vladimir Putin has won a fifth term as Russian president, extending his almost 25-year rule for another 6 years to 2030. The election results saw President Putin receive 87% of the vote in a record turnout of 77.5%. But he faced no credible opposition candidate as the Kremlin banned opposition parties and outlawed any criticism of Mr. Putin or his war in Ukraine. Central banks that oversee 40% of the world's GDP will meet this week. They include the US, UK, Japan, Taiwan, Australia and Indonesia. There's intense speculation that the Bank of Japan will raise interest rates for the first time since 2007, ending the world's last negative rate when its meeting concludes later today. In the US, policymakers are expected to hold steady on interest rates until it's clear that price surges are contained. The combination of the two-day meeting also includes the FOMC's economic forecasts and the so-called dot plot interest rate projections. Chinese industrial production leapt 7% year-on-year in January and February combined, up from 6.8% in December. It was the fastest rate of growth in 23 months. But while China's industrial activity surged, domestic demand remained lackluster. Retail sales grew by 5.5% year-on-year, down from 7.4% growth in December and below economists' forecasts. Saudi Aramco's chief executive has said the world should abandon the fantasy of phasing out oil and gas, arguing low-carbon solutions and new energy sources should only be phased in when they are economically competitive. Amin Nasser said forecasts by the International Energy Agency that oil demand would peak by 2030 were not going to be met due to surging demand from countries in the global south who couldn't afford expensive energy solutions. On today's Money Talk, I'm joined by Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia, Karine Hirn, Partner and Chief Sustainability Officer at East Capital Group, and our US economics correspondent, writer and broadcaster, Barry Wood. And as always, if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
Technology stocks lifted Wall Street higher on Monday. The S&P 500 rose 0.6% to 5,149, with the index rebounding from 2 consecutive weeks of losses. The Dow climbed 76 points, or 0.2%, to settle at 38,790. The tech-heavy Nasdaq Composite advanced 0.8% to 16,103, with gains for all of the so-called Magnificent Seven major technology stocks. Alphabet made a big contribution to the S&P 500's ascent, with shares up 4.6%, following reports that Apple is in active negotiations to build Google's Gemini artificial intelligence engine into the iPhone. Gemini is Google's suite of generative artificial intelligence tools, ranging from chatbots to coding assistants. Nvidia shares gained 0.7% on the first day of the company's GTC conference, after being up more than 4% earlier in the session. Nvidia on Monday announced a new generation of artificial intelligence chips and software for running AI models. The yield on the 2-year and 10-year Treasury notes rose for the 6th session in a row to 3-week highs. The 2-year yield was up 1 basis point at 4.74%. The 10-year climbed 2 basis points to 4.33%. Currency market traders were in wait-and-see mode ahead of a slew of risk events, including central bank meetings and PMI data. The yen was a touch softer versus the dollar at 149.18. In Shanghai, the yuan was unchanged at 7.1981 renminbi per dollar. Spot gold ended the session 0.2% higher at $2,159 an ounce. Brent crude oil climbed 1.8% to a new 4-month high of $86.89 per barrel. And Bitcoin ended trading in New York Monday 1.7% lower at $67,200. Standard Chartered's head of digital assets research said in a note to clients Monday that he's raising his year-end target on Bitcoin to $150,000 $60,000 from his previous target of $100,000. On the mainland, the Shanghai Composite rose 1% to 3,085, with technology names notching the largest gains. Sentiment was buoyed by better than expected industrial production and fixed asset investment figures in China during the first 2 months of the year. In Hong Kong, the Hang Seng edged up 16 points, that's 0.1%, to end at 16,737 after slipping in the prior 2 sessions. It was mainly supported by gains from tech and consumer stocks. And Hong Kong earnings are in focus this week, with around 30 Hang Seng companies, including Tencent and Meituan, reporting results. Futures markets pointing to a decline of about 60 points for the Hang Seng at the open this morning. Trading should get started with the index at about 16,675 points. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our Tuesday morning guests. We have with us Mark Michelson, Chairman of the Asia CEO Forum at IMA Asia over in Hong Kong. Morning, Mark.
Good morning.
And we have Karine Hirn with us, who is Partner and Chief Sustainability Officer at East Capital Group, also in Hong Kong. Morning, Karine.
Good morning.
And this morning, over in Cleveland, Ohio, for a change, we find Barry Ward, our US economics correspondent, who's searching for good weather. Have you found it?
No, but I wanted you to see the snow just outside these windows, because I'm at the rest stop here at Cleveland on the Ohio Turnpike. And of course, it's below freezing. So it wasn't pleasant driving from Washington to Cleveland, but here I am. Good morning.
Well, I hope it's worth it for whatever reason you're there.
Yeah, I can't imagine.
Let's start in China this morning. Chinese economic activity was strong in the first 2 months of 2024, driven by supply-side factors. Industrial production leapt 7% year-on-year in January and February combined. That's up from 6.8% in December. That's according to data from the National Bureau of Statistics. It was the fastest rate of growth in 23 months and above an anticipated 5% rise from economists polled by Reuters. But while China's industrial activity surged, domestic demand remained lackluster. Retail sales grew by 5.5% year-on-year. That's down from 7.4% growth in December and below economists' forecasts of 5.6%. In response to weak demand, companies are laying off workers. Unemployment has ticked up for 3 consecutive months now, rising from 5% in November to 5.3% in February, and it was the highest reading since last July. Meanwhile, fixed asset investments grew by 4.2% year-on-year, up from 4.1% in December. That's the fastest rate in 11 months. Infrastructure investments, that surged by almost 10%, spurred on by the initial deployment of the 1 trillion yuan in treasury bonds that were issued late last year. But the slump in property investment continues. It was down 9% year-on-year. Mark, is this data sort of chiming with what your members are reporting about activity on the mainland?
Well, to some extent. Just a couple of comments, and be interested to see what Karine and Barry say to this. First of all, it's great to see the industrial value added rise, but it's a low base. It's based on last year's low base. There are also seasonal factors. What they're really looking at, not only our members, but a lot of other people, it's what's happening with property. And there's just not much movement. We have the white list now for local governments to help support property companies. And although it's maybe a little early to tell what the results are going to be, not much has happened. So that's the concern. In fact, completions dropped, I guess, 20% year on year. In terms of housing, and housing sales already declined. Also on consumer spending, the other worry is what you just described. Some unemployment is going on. Also, there's not much to at least to bolster consumer confidence at this point. Those are the worries. In other ways, it is there's some green shoots there, and we hope they're going to come good. But still, I suspect the Chinese government's going to have to do more to boost the growth ultimately to near its target of 5%.
Karine, what are your thoughts on the data? Important data, isn't it? Because we haven't had anything for a couple of months because of the Chinese New Year holiday. So this is really the first look at economic activity for a while. What are you seeing?
Yes, exactly. This is a time of the year where everyone is looking very much into these numbers and trying to make some forecast and this year it's maybe more important than ever because we do have both a situation where economic growth has seriously slowed down, and we just had the two conferences, the two meetings where it was kind of difficult to know exactly or to get this level of confidence that the market was expecting, or at least was hoping for. The overall high-level forecast or target of economic GDP growth in 2024, around 5%. I think most people believe it's actually quite hard to reach because it's the same as last year. Last year we had a base effect from the year before, and we do have all the issues mentioned by Mark, specifically regarding the property market. So what we see as these numbers were kind of mixed, as you said, and basically, but quite a lot of it was not as negative as people had expected. So now we're back to the situation where we say, okay, so what are the Chinese policymakers thinking? And probably that means that they will not be very aggressive in terms of how they want to stimulate the economy and adjust it. So maybe it is a bit disappointing if you are investors, the kind of investors just relying on this kind of issue of how sensitive the data is and what kind of stimulus there would be and so forth. So we'll see. One mention regarding the property sector, which is not discussed in these numbers because the government doesn't release these kind of numbers, but I think it's very interesting, and I think we did mention that actually last time I was on the podcast, is the what's going on in terms of housing sales. Clearly, new home sales are down a lot, but we keep seeing a trend which is really ticking up regarding this on the secondary market. We have 2023, the numbers we have is the secondary market was up 40%, while the new home sales were down 8%. And this is not only a situation where in terms of base, that the market is very small. We had last year, in terms of secondary market, was 570 million square meters, where new home sales at 950 million square meters. So, of course, the new home sales market is still much bigger, but it's not the fact that the secondary home market is completely insignificant. So in large cities now, you have more than half of the sales on property market are secondary home sales. Why is that important? Clearly, it doesn't create the same kind of value in terms of construction. And that's why people are disappointed if you're investing into this theme. But it's very important as a way to show that clearly Chinese consumers, of course, they still need a home. They still have money to spend on buying a home. And a big part of the problem of the property market is a confidence issue due to the fact, of course, that you wouldn't want to put money on the side to think about buying a new home when you don't even know if you get the new home because you don't know if the property developer you have basically used it will go bust. So we think it's very important for the consumer sentiment. And overall, again, if you look at across our portfolios, of course, there are companies which are doing very well. So it's not like a situation where we have a complete recession scenario and so forth.
Okay. But Barry, one thing that stood out in this data is the supply-demand mismatch. In other words, supply is growing much faster than demand and the local economy's capacity to support that. So it's going to make exports an increasingly important growth driver for China throughout this year. But what I'm wondering is, with all the rising trade tensions, this strategy is going to become increasingly untenable, isn't it? Because there just isn't the willingness in the US and the EU and elsewhere to absorb all this excess supply, oversupply from China.
That's correct. Donald Trump was over the weekend in Ohio, and he talked about if electric cars from China come in to the U.S., he'll hit them with 100% tariff. Well, I don't think that would happen, but that's what he said. I would just offer a couple things. I spoke to a friend in Shanghai, and that person said that at the sports marketing firm that he worked at, about 1/4 of the staff had been laid off in the last couple months. And secondly, CBS 60 Minutes program, Leslie Stahl is in Beijing, or was recently, talking to Nicholas Burns, and they walked along. It wasn't Shanghai or Beijing, it was a first-tier city, and you just saw row after row of empty buildings. So, yes, I'm sure that the housing issue is paramount in China, and whether people are going to get their confidence back, I do think that if deflation is exported, it does help the U.S. inflation rate. It drives it down. So at the big box retailers, it will be welcome, but certainly not in the auto sector.
Because this is quite deflationary, isn't it, when you've got this sort of overcapacity going on? So presumably that is the way in which China exports its deflation around the world, or one of the ways.
And it's very useful to American consumers and I think European consumers.
You mentioned that Donald Trump's threatening to put 100% tariffs on electric vehicle exports from China. I'm wondering what he might do to electric vehicle exports from, say, Mexico, because it turns out that actually what's happening is China is investing in plants in Mexico, and those cars that are coming from Mexico across the border are really sort of, partly sort of Chinese made and have Chinese components in them.
Well, I know Mark has got a comment on this, and I look forward to hearing that. But in terms of the United States, Mexico, Canada free trade agreement, he would not be allowed to do that. Now, he could find a loophole, perhaps, for some reason. But as long as there is some local content from the way that's worded in the USMCA, there has to be some United States high wage input into the car. But let's not forget, BYD has yet to build its factory in Mexico. So that's not going to happen instantly, nor is the American election going to be ahead of November.
What the issue is, I mean, that's part of it. But even if it's not BYD, if it's other electric cars that do not have Chinese brands on them, but still Chinese suppliers are contributing to them, that's potentially a political issue. I don't know if that'll come up to it, but clearly there are organizations, institutes, think tanks looking at this very clearly, and many of them are advising both presidential candidates actually. So I think it could become an issue, and it's going to increase until it's stopped. Until there are some impediments put in its place.
I think we are in this classical thing. We say a friend of my friend is my friend. Well, maybe not when it comes to trade, because clearly friendshoring, you need to look at what's behind it. It's not only Mexico, and there are a lot of other countries, including, for instance, Vietnam, where clearly it's the case. Personally, I think in deflation is the number one issue and the number one challenge for the Chinese economy. Because it's got a really disastrous impact in terms of investor sentiment for both investors like us, but also, of course, for actually Chinese companies which are not willing to put more money into something they can't get profit out. But where we're seeing the export trade issues basically mean that more and more of Chinese companies are actually looking at other markets, which are less complicated, which are less risky. And that's where it comes the whole global South idea and regionalization of trade. So both in Southeast Asia, but looking to what's going on in between, for instance, China and Africa, for instance. So the way we play it ourselves as an equity investor is finding companies where the exports is not going to the US, and there are some very interesting companies which are listed on the market, which give you that kind of exposure. Because I think increasingly it's going to be hard for Chinese companies which are super competitive to gain market share in these markets because they basically this rise of Chinese companies means a risk for jobs in US and in the EU, and this is something politicians cannot allow, basically.
No doubt. Peter, one comment on something else you raised, and it's about consumer spending again. Clearly, our members are looking for that to turn around. And it's not a matter of disposable income because there seems to be quite a lot of it. It's just when buyers are going to feel confident that they can begin to spend again at reasonable levels, and that hasn't shown itself yet. It may, but not yet.
Buyers have got to get that confidence without an awful lot of help from the governments, haven't they? Because it looks
That's right.
particularly clear that the government doesn't want to roll out the big bazookas. It really is going to be quite cautious in terms of providing stimulus.
Yeah, for some of the reasons that Karine just mentioned, I think.
Okay. Well, central banks that oversee 40% of the world's GDP are going to meet this week. It includes the US, UK, Japan, Taiwan, Australia, Indonesia, a whole host of others. The two that are going to face the most scrutiny are the US and Japanese central banks. Let's start with Japan. Intense speculation that the Bank of Japan is going to raise interest rates for the first time since 2007 when its meeting concludes later today. Now, that speculation has been stoked even more by an article in the Nikkei newspaper yesterday that said the Bank of Japan is going to end its negative interest rate policy, it's going to end its yield curve control policy, and also stop purchasing ETFs as well, although it will purchase, this article said, some Japanese government bonds to help smooth out the movement in yields. Barry, let me start with your thoughts on this. Interest rates in Japan, minus 0.1%. Lots of talk about the Bank of Japan raising interest rates. How significant is it? Because at the end of the day, they're still going to be around zero, aren't they? They're still going to be the easiest monetary policy in the world. So am I missing something here in getting too excited about this, or is this something that's really significant?
Well, I think it's very significant if indeed they change their interest rate policy. But I'm going to defer to Mark. Mark has lived in Japan. I have not. I haven't been in Japan for a year. So I'm going to pass that one off.
That's a lot of pressure, Barry. I'm not sure if I can handle it. Yeah, in a sense, on the surface, it is dramatic. But you're right, Peter. It's not very much. And for almost certainly, and this is no shock to anyone, the Japanese are going to proceed slowly and incrementally in terms of what they're going to do with this, in part because they don't want to destabilize a highly indebted government, and they have many weak SMEs as well. And that's as much of a concern as inflation in many cases for the Japanese, and that might leave the yen weak as well. So it's going to be slow, but big changes. I mean, this is raising it for the first time in moving to guided interest rates up for the first time in 17 years. That's a long time ago. Even more importantly, in some ways, and what's helping to trigger this is wages. Wages are going to go up almost 5.3%, which is enough, but doesn't sound like, dramatic, but it is for Japan. It's the first time since a guy called Hosokawa was prime minister 33 years ago. So this, for Japan, they usually don't move dramatically. And in some cases, at least in terms of sentiment, it is dramatic. In the short term, it's going to have much impact. Probably not a lot, but and of course, everybody's been predicting it for quite a long time. But nonetheless, it's a move. It's a strong move in a different direction, which again doesn't happen very often.
Has Japan? Sorry.
No, I just wanted to say as well, first of all, I agree that the signal is still very important and very strong. But it's not only the first time in years and years, but it's also, the Bank of Japan is basically the last one, which still is a negative interest rate regime. So once it happens, then, we are basically where there's a new chapter, for us to stop, so to say.
Has Japan hit this virtuous circle that the BOJ wants to see, where, in other words, there's now a change in corporate behaviour, there are rising wages, that in turn boosts domestic consumption? This is what the Bank of Japan has been looking for a while. Has Japan got it now, that positive circle, virtuous circle?
Well, they do have it, but do they have it enough? Is it a solid trend line? That's why I wouldn't be surprised if they wait. But again, I think, as Mark says, they're going to be very cautious. They gave up being dramatic in their moves back 80 years ago.
Karine, does this change at all the investment perspective for Japan as an investor? Looking at this sort of historic change now, does it change your approach at all to Japanese equities?
So Japan has done very well recently. So, as always, you might think that it could also be an opportunity for some investors to exit the market, and you could see some correction. At the same time, this is so widely expected that probably it will be the other way around. It's like if it doesn't happen, then maybe people will start questioning the investment case. But otherwise, I wouldn't say that. I don't think it keeps people awake at night, so to say. So.
And what about Japan's offshore funds? They've got a lot of money offshore, haven't they? About $4 trillion in offshore funds. Does this rise to zero? Start getting any of that funds back on shore, or is it just too insignificant at the moment? And if so, at what point does that money start repatriating? Because then that would have a big impact, wouldn't it, on global markets if that money started to repatriate back to Japan?
Peter, it's a great question, and it is a great question because we hear very little about it. I've never even thought about it myself, so it doesn't mean that I'm thinking about everything that is important. But still, you do have, whenever there is some change in the US or on the US dollar, then we're always reflecting on what it implies for domestic equities and monies flowing in and out. But in the case of Japan, clearly that could be a topic here. Maybe for equity markets eventually it's not that important, but I think more like as Japan being a big investor provider of foreign direct investment for some countries, especially in Asia and Southeast Asia. Maybe this could have a long-term impact. But I'd like to hear from Mark and Barry any of their thoughts regarding this question.
Well, they're going to stand pat. They're not going to move money. I think they're very happy to see the United States economy grow. I think their companies are doing very well in the United States market. I think their holdings of treasuries are good. They're getting a positive return. So I wouldn't expect any move.
Mark, what about business executives? Are they at all preparing for this? Because we're seeing now rising wages, of course, aren't we? We're seeing inflation start to pick up. Are companies who operate in Japan, are they talking about this? Are they preparing for this end to the negative interest rate policy?
Well, it's not just negative interest rate policy. Many of them have been looking again at Japan for a while now. Not as the answer to everything, but certainly as an option, as an alternative. So some companies are moving or setting up operations in Japan, which maybe they wouldn't have thought of doing a few years ago. A part of it's the skills. These would not be labor intensive, obviously, but they'd be high value added operations, not just from all over the world. So Japan's suddenly become interesting again. As I think I've mentioned earlier in these programs, one of my friends works at the U.S. Embassy in Tokyo, and he said he's never been busier in terms of inquiries and visits by people. Doesn't mean they're all going to invest, doesn't mean they're all going to be there. But it was pretty quiet for a while, especially during the last few years.
What you say is matched by my own perception here in the States, because you're hearing comments after 30 years of nothing. Japan is now going to grow and is found its way forward. So, yeah, I think there's a lot of interest in Japan.
And it's become famous now because it always gets compared to the Chinese economy. For good or for bad.
So, Barry, the Bank of Japan meeting is clearly a live meeting, isn't it? Things could go either way here. The Fed meeting, though, where we'll get the decision from the FOMC in the early hours of Thursday morning, Hong Kong time, that isn't a live meeting, is it? They're not going to cut rates.
Absolutely, you're right. And this is an interesting element because most of the focus will be on the dot plots that come out every 3 months. And let's see what those members of the FOMC are projecting. I now see that there are some signs of weakness in the United States housing sector that weren't apparent a few weeks ago. I think Jake Powell's press conference on Wednesday will be important. I think the Fed wants to wants to cut interest rates 3 times this year. It won't be before June, but there are even people saying that there are strong signs that the United States could slip back into much slower growth or even recession. So no drama coming on Wednesday, but there's a lot to be learned from what is revealed.
It'll be interesting to see, won't it, on these dot plots, whether or not the Fed shifts from where it is at the moment, which is 3 rate cuts, 75 basis points of rate cuts in total this year, and sort of moves it downwards to around 2, which some people have been suggesting, just as the market has caught up with the Fed. They finally are in tandem with the Fed, but it'll be interesting to see, won't it, if the Fed changes that.
Yes, it will be very interesting. And I think the markets are still absorbing 11 interest rate rises that ended in July of 23. But that was unprecedented, the speed of those rises in short-term interest rates. Now we have positive interest rates. We have 7% mortgages where they used to be 3 for about 10 years. So yeah, I think we're absorbing that. And what does the stock market tell us? We've absorbed it. So far, so good.
Karine, the stock market reaction, of course, also going to be interesting here, isn't it? Because we're seeing bond yields now move back up to sort of multi-week highs. The 10-year jumped about 23, 24 basis points last week. It seems to be at the level now where that's becoming a headwind for stocks once again.
Yeah, yes. At the same time, I think a lot of people, including ourselves, kind of wonder really where does all this money come from anyway? so that's
yes.
And to look at the numbers that of the money pouring into a Bitcoin ETFs, $50 billion in just 1.5 months. It's mind blowing. So let's see how long the party goes on, so to say.
Where is that money all coming from? Because there's clearly enormous liquidity around, isn't it? That's driving stocks around the world to record highs. Bitcoin, gold has been at record highs as well. Clearly, monetary conditions aren't tight when that's happening, is it?
No, yeah, exactly. So, there's everything from the COVID still hangover money to including all these flows that have been built into the system, lower energy bills, a lot of speculative money, a lot of uncertainty. So people are just moving assets back and forth. It is really the big question. Where does all this money come from? For sure.
And of course, the government borrowing more and more, so they're having to issue bonds,
indeed.
which the Fed has to buy,
exactly.
which then ends up in the banking system and then ends up in consumers' pockets again. So presumably that's another source of this liquidity, this enormous liquidity that we're seeing.
Yeah.
Mark, in terms of sort of companies, are they used now to interest rates at these levels? Can they live with them at around 5.25%, 5.5%?
Well, they have to be used to them, right? I guess. And it's, it doesn't mean they're not concerned, but it maybe doesn't come up as much as it used to. There was a shock a little bit at the beginning when they had to make adjustments. But, looking forward, they're preparing, of course, for an easing of rates, except for Japan, which is going to go the opposite direction. But at the same time, not looking that to have a dramatic effect, and more interested in other issues, including geopolitics, which we've mentioned before, and worries about that ramping up if that's possible this year.
Barry, this meeting, the Fed meeting, it's not about now, is it? It's about the future. It's going to be important, as you mentioned, to see the dot plots. Also, what Jerome Powell thinks about the economy, the direction of the economy, what he thinks about inflation, whether it's still too sticky for his liking. This is all about what's going to happen in June and beyond.
Yeah, I think that it's not impossible that Mr. Powell will say that the inflation trend downward is, in fact, getting to be quite impressive. And I say that because of a couple things that I've observed. One is that housing prices in Florida, which it should be remembered is the 3rd or 4th largest population of any U.S. state, have come down, and rents have come down. I know that personally because I have a condo that I rent for the season. Prices have come down. That's counterintuitive to what was expected 6 months ago. or even 3 months ago. Those are positive trends. Gasoline prices are depressed. And if the Chinese are going to start or have already started sending the products that fill the shelves of the big box retailers, they're holding steady. That means, I think, inflation in the United States is going to not accelerate from 3%, but go pretty steady along that 3% line.
This has been the hard part, isn't it? Getting that last 1%, getting inflation down to the target at 2%. But do you think the Fed is comfortable with where it is now?
Yes.
So, but Barry will have less money to spend, basically.
That's true. Once again.
Now, Saudi Aramco's chief executive has said the world should abandon the fantasy of phasing out oil and gas, arguing low-carbon solutions and new energy sources should only be phased in when they are economically competitive. Amin Nasir told a major oil and gas conference in Houston on Monday that the current energy transition strategy is failing. He said forecasts by the International Energy Agency that oil demand would peak by 2030 were not going to be met due to surging demand from countries in the global south who couldn't afford expensive energy solutions. And he said demand is unlikely to peak anytime soon, let alone by that year. He said we should abandon the fantasy of phasing out oil and gas and instead invest in them adequately, reflecting realistic demand assumptions. And he said we should phase in new energy sources and technologies when they are genuinely ready, economically competitive. So what do you make of that, Karine? Is the energy transition strategy failing?
So I was wondering whether you actually wanted me to be in a bad mood on a Tuesday morning hearing about these comments.
Sorry about this. Wasn't me, though.
Yeah, no, exactly. No, I was just wondering if this guy got a standing ovation when he was in Houston at the oil and gas conference to claim that these kind of things. I mean, it's a bit like...
bit self-serving, isn't it, really?
Yeah. I could suggest some other places where he could mention this, make these comments, and I'm not sure people will be as enthusiastic. I mean, clearly, there's a lot going on in terms of, the whole issue. Of course, the oil and gas sector is basically seeing its fate being written on the wall. I mean, it is not true. I mean, we already have many of these technologies which are more competitive and highly competitive, and very much thanks to all the money that has been spent, including from China, into these technologies. So it is. There's a lot going on. There's a lot going at play here in terms of the transition to greener energy systems. And what just when I was saying, I was joking, saying it does make me be in a bad mood. It does really make me be in a bad mood, because I feel like right now we do have, I mean, we all know, just listen to the signs. We all know that we do have a major challenge, which is not ahead of us. It's already today here. And it is because of the fact that we've been burning too much oil and gas and using coal for decades. And we need to shift as soon as possible. And we need also to put a lot of money into climate adaptation because of the impact is already here. So we don't want to hear these kind of comments from the chief executive of what is today, I think, one of the largest, if not the largest, no, it's not the largest, but it's one of the largest companies in the world in terms of market cap, because it is sending signals to the financial sector as well in terms of both investments and banking and lending and so forth. So. Again, we'll see, but it is. I mean, it is interesting. It's an interesting conversation, and it's good to hear his comments. But it doesn't make me think that, oh my gosh, like yes, you're right. He's right. Let's stop investing into cleaner sources of energy, because we're still going to make a lot of money in oil and gas for years to come. This is the year is 2024. It's no longer the time to have even this kind of conversation.
Karine, I really do agree with what you've said about the climate emergency and the need to change. But let us not forget that in China, North America, and Europe, the move towards electric vehicles is coming from the top down. The consumer didn't really have any say in any of this. And I think what the Saudi Aramco chief is saying is correct. There's already a lull here in the North American market in terms of EVs. And as the Chinese have been commenting about, the price declines for electric vehicles is making a very competitive environment, despite all those government subsidies. And that's going to happen here in the States. Now, as the price of electric vehicles go down, I think there'll be a resurgence in EVs, but not at the moment.
Yeah, my concern is sentiment, because Karine's, I think, outlined what the issue is. And I'd say not only as soon as possible, probably sooner than possible, we have to make some of these changes. And some places recognize it, and I think China's a good example, at least the leadership does there. But it's, still most people, feel comfortable with fossil fuels in many ways. And in the U.S. presidential campaign, which Barry knows a lot more about than I do, I have a feeling this is going to be a talking point, at least for some candidates, and saying, see, and some have, and electric vehicles are a bad word, according to some leading candidates, including one that's running for president. So,
Mark,
it's a bit of an issue, right?
In this plaza on the Ohio Turnpike, there are 10 stalls of Tesla superchargers.
Yeah.
There's not one car there. But that shows that the infrastructure is being built. It's all there. So we are making the shift, but consumer sentiment is negative towards EVs.
In Hong Kong, where we still see a lot of Mercedes, but you see a lot of Mercedes. Yesterday, when I was driving, I think in a period of 20 minutes, I saw at least 15 Teslas, maybe more. They're ubiquitous. They're everywhere. So it's starting to have an impact, at least in some places.
But Karine, if these carbon neutrality goals are going to be met, doesn't it need firms like Aramco to be investing more in renewables?
Oh, yes, absolutely. And that's why, it's clearly they are part of, they must be part of this, I wouldn't call it game, but this huge transformation. So, and that's where actually investors now are more or less really kind of losing patience with many of these companies, which have been claiming that they're doing their part. But just look at the numbers. What they invest into cleaner sources of energy is minimal. So they need to do more. And the same goes with banks, which are supporting them. So, but you cannot. I do not see a future where suddenly these companies will come down, and that we will just see the emergence of greener green energy champions. These companies, the brown companies, need to become green. That's what will kind of save us, or at least save the planet. I'm not sure if we can be saved.
And it needs investors to make that happen as well, doesn't it? For investors to be more active in this process.
Yes, exactly. So that's, in the back of all these comments, we're talking about the political cycle in the US and what it implies when you have basically, the US has now become one of the largest countries in the world, which are producing oil and gas. So we also see, of course, all the vested interest around the topic. But that's where the ESG pushback that we see in the US is also hurting, obviously, because it means that part of the money that would otherwise been allocated to greener sources of energy goes back or stays with the brown, so to say. So we do have a number of topics here which are of concern, really, for investments, for sure.
I've got a positive note. A group of students in my class on international finance and trade policy, their project presentation is going to be on the low carbon economy and its effect on the international economy. So that's not, that's positive, and they came up with that themselves. And that's almost every year we have at least one or two presentations on that, and these are mostly mainland students. So clearly there's a concern there.
One thing that I find slightly baffling is that both OPEC and the IEA make these demand estimates, what they think global demand is going to look like over the coming months and year. There seems to be vast differences between the two sort of numbers. OPEC is always predicting much higher demand than the IEA is. We know that's really the Western organisation, isn't it? It tends to represent the Western nations, the IEA. Is it maybe is there some truth in it that perhaps the IEA is underestimating demand in the global south in emerging economies?
could be. I think the big issue as well is that electrification is a great trend, but you need energy to electrify, and as systems and infrastructures are still not yet very green, you'd actually create excess demand to be able to electrify. So that is one part of the equation, I think.
Final thoughts from you, Barry. I mean, what is clear is that this is going to be an election issue, isn't it? Particularly with Donald Trump in the running. We know what he thinks about coal and renewable fuels. This is clearly going to be something that's going to be talked about over the coming months.
Yes. Stay tuned over these next 6 months. But you're right. Donald Trump is the anti-green guy, and Joe Biden is the green guy.
Okay, well, it's going to be an interesting time. Fascinating discussion this morning. Thank you all very much for your thoughts there. You heard there Barry Wood, our US economics correspondent in Cleveland, Ohio. This morning, Karine Hirn, who is partner and chief sustainability officer at East Capital Group, and also Mark Michelson, who is chairman of the Asia CEO Forum at IMA Asia.
You're listening to Peter Lewis's Money Talk. Money Talk.
Thank you for listening this morning. I'll be back tomorrow with more business and finance headlines. To discuss them, I'll be joined by Enzio von Pfahl, capital preservation specialist at Financial Shield, and Mark Franklin, managing director and senior portfolio manager of multi-asset solutions at Manulife Investments. And with a view from Japan is Tokyo-based journalist and author William Pesic. See you tomorrow.
Money Talk.